Today, we're breaking down the top 10 investment strategies for beginners to help you kickstart your financial journey with confidence. Investing can seem overwhelming at first, but with the right approach, you can build a solid foundation for long-term success. We'll guide you through essential strategies like dollar cost averaging, diversifying your portfolio, and understanding risk tolerance. Whether you're aiming to grow your wealth or secure your future, these beginner-friendly tips will set you on the right path. Stay tuned as we uncover the best investment strategies for beginners, making the world of investing simpler and more accessible. Today, we will talk about top 10 investment strategies for beginners. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we're going to take you through the top 10 investment strategies for beginners, from simple, low-risk options to long-term, growth-focused techniques. These strategies will give you a clear roadmap to follow, even if you're completely new to the world of investing. Stick around till the end, and by the time we're done, you'll feel more confident about taking the first step toward growing your wealth. 1. Start with a financial goal. The very first thing to do before you put any money into an investment is to understand what you're aiming for. Your goal is the foundation of your entire investment strategy. Are you saving for retirement, trying to accumulate a down payment for a home, or are you simply looking to grow your wealth over time? Defining this will not only help you focus on the right kinds of investments, but also set realistic expectations for how long it might take to reach your goal. 2. Build an emergency fund first. Before you dive into the stock market or any other investment vehicle, it's crucial to have an emergency fund in place. Many beginners overlook this step, but it can make a world of difference. Imagine you lose your job unexpectedly, or your car breaks down. Without an emergency fund, you might be forced to sell your investments at the wrong time, like during a market downturn, just to cover those expenses. 3. Understand your risk tolerance. Risk tolerance is a personal thing, and it's important to understand where you fall on the spectrum. Some people are comfortable taking big risks in hopes of seeing larger returns, while others would prefer safer, steadier growth. This is something only you can decide, and it's a key factor in shaping your investment portfolio. However, if you know that big losses would make you lose sleep, you may want to stick with more conservative investments like bonds or dividend-paying stocks. Balancing your risk tolerance with your investment goals is essential for building a portfolio that you can stick with long-term. 4. Diversify your investments. One of the most fundamental principles of investing is diversification, which simply means spreading your money across different types of investments to reduce risk. Imagine putting all your money into one stock. If that company experiences trouble, you could lose a significant portion of your portfolio. But by diversifying, investing a mix of stocks, bonds, real estate, and other assets, you can protect yourself from the poor performance of any single investment. For example, instead of investing only in tech stocks, you might also invest in healthcare, energy, or consumer goods companies. You can also diversify geographically by investing in both domestic and international markets. This way, even if one part of the world's economy is struggling, another might be doing well, and your overall portfolio is less likely to take a hit. 5. Start with low-cost index funds. If you're just getting started, one of the easiest and most effective ways to invest is through index funds. These are funds that track a specific market index, such as the S&P 500, which includes 500 of the largest companies. The U.S. index funds offer a way to invest in the entire market rather than trying to pick individual stocks, which can be risky and difficult for beginners. One of the biggest advantages of index funds is their low cost. They don't require the high fees of actively managed funds because they simply aim to match the market, not beat it. And historically, index funds have outperformed the majority of actively managed funds over the long term. This makes them a great option for beginners who want to keep things simple while still benefiting from the growth of the stock market. 6. Invest consistently with dollar cost averaging. Many new investors make the mistake of trying to time the market, buying when they think prices are low and selling when they're high. The reality is, even experienced investors find it nearly impossible to time the market consistently. That's why one of the best strategies for beginners is dollar cost averaging. With dollar cost averaging, you invest a fixed amount of money at regular intervals, no matter what the market is doing. For example, you might invest $100 on the first day of every month. Some months you'll buy shares when prices are high and other months when prices are low, but over time, this approach helps smooth out the volatility of the market. You end up with an average price, and you don't have to worry about trying to predict the best time to invest. 7. Maximize retirement accounts. If your employer offers a retirement plan like a 401 loan, make sure you take advantage of it, especially if they offer a matching contribution. Employer matching is essentially free money, so it's important to contribute enough to get the full match. For example, if your employer matches 50% of your contributions up to 6% of your salary, make sure you're contributing at least 6% to capture that full match. Retirement accounts like 400 OMICs and IRAs, individual retirement accounts, also offer significant tax benefits. Contributions to a traditional 401 or IRA are tax-deferred, meaning you don't pay taxes on the money until you withdraw it in retirement. This can help reduce your tax bill today and allow your investments to grow tax-free until you retire. 8. Reinvest dividends. When you invest in dividend-paying stocks or funds, you'll receive regular payouts as the companies share their profits with shareholders. For beginners, one of the best strategies is to reinvest these dividends rather than spending them. By reinvesting, you buy more shares, which can help compound your returns over time. For example, if you invest in a stock that pays a 4% annual dividend, reinvesting those dividends allows you to purchase more shares, which in turn will generate even more dividends in the future. This snowball effect can have a powerful impact on your overall investment returns, especially over the long term. 9. Stay the course during market volatility. One of the hardest things for new investors is staying calm during market downturns. It's tempting to sell when you see your investments losing value, but this is usually the worst thing you can do. Remember that market volatility is normal. Historically, the stock market has always recovered from downturns and continued to grow over the long term. The key is to stick to your strategy and not let short-term fluctuations shake your confidence. If you panic and sell during a downturn, you'll likely miss out on the market's recovery. By staying invested, you give yourself the best chance to benefit from the long-term growth of the market. 10. Keep learning and growing as an investor. Investing is a journey, and the best investors are always learning. The more you understand about the markets, the economy, and the various types of investments available, the better decisions you'll be able to make. Consider reading books, following financial news, and even seeking out educational courses on investing. You could also consider working with a financial advisor to get personalized advice. Starting your investment journey can feel overwhelming, but by following these 10 strategies, you'll be on the right path to financial success. Define your goals, build your emergency fund, and stay patient as you build wealth over time. No matter where you are in your financial journey, the key is to start today. With these strategies in hand, you'll be better equipped to navigate the world of investing and grow your wealth for the future. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.